Hey, welcome everybody. Glad you guys can make it. I'm really excited by this company. I'm very bullish on copper, and they have got a world-class copper prospect that they're developing down in Ecuador. But anyway, welcome to today's webinar. It's being hosted by Solaris Resources, an exploration company that is advancing several copper and gold projects in Central and South America. Solaris Resources is a public company based in Toronto with offices also in Vancouver. It is advancing a portfolio of copper discoveries in Central and South America. Most of today's presentation will focus on what the company believes is a global scale resource of high-grade copper in Warintza, Ecuador. Copper prices have pulled back recently from all-time highs set in March of 2022, but Goldman Sachs is forecasting a global copper shortage by the end of 2024. As most of you know, we've talked about, it takes about 6 times more copper to make an electric vehicle than it does an internal combustion vehicle. So that's where all this copper demand is going to be coming from. Joining me today is our speaker, Daniel Earl, the company's president and CEO. Also on today's panel is Jacqueline Wagner. She's the VP of Investor Relations. She joined Solaris in 2019. She has 15 years of experience implementing strategic investor relations programs for publicly traded issuers. Daniel Earl has over 17 years of experience in the mining sector and capital markets, covering projects ranging from the early stage exploration through feasibility and engineering to production. He is currently the president and CEO of Solaris Resources, also serves on the board of directors. Prior to joining Solaris in November of 2019, he was a vice president and director at TD Securities, where he covered the mining sector for over 12 years and established himself as a thought leader in the space. Daniel also sits on the board of directors of Augusta Gold Corp. He's a graduate of the mineral engineering program at the University of Toronto. And I just want to remind you that during the webinar, if you have any questions, please type them into the chat box and we will answer them after their formal presentation. With that, I will turn it over to Daniel Earl for an update on the company.
Thanks so much for that, Dan. Really appreciate it. And before I get going, let me just apologize up front. If anyone's getting the background noise, we've got a fire alarm going on here in the building. So, Dan, if you see the room starting to fill up with smoke while I'm trying to present here, you just cut the feed, and I'll make my exit stage right. But yeah, so thanks for having me. Of course, this is actually one of my favorite groups to present to, with a lot of engineers, a lot of geologists in the audience. My background, as you mentioned, is in engineering, but I've worked also as a geologist in industry. And that was prior to coming over to the capital market side of the business, where I worked as an equity research analyst for about a dozen years for one of the major banks in the mining finance space. And it was specifically opportunities like this one with Solaris and its Warintza project that I was looking for that entire time. And that's really where you're able to make big returns for your clients across different parts of the cycle, is in assets like this. And so that was the opportunity that I left that position at the bank to join this company as the founding president and CEO. And but before I kind of get too far into describing that history, let me just say that the credit for this company and the Warintza project, this is a world-class discovery that resides with David Lowell, who unfortunately is no longer with us. He passed away a few years ago, but this is arguably the world's greatest explorer. I think certainly in copper. Just an American great in the history of the mining sector. He made over a dozen major discoveries, including the largest copper mine in the world, which is La Escondida. This is twice the size of the second largest copper mine in the world. And really with this company, what we're doing is we're bringing the Warintza project to its full fruition. Okay, and even beyond Warintza, you'll see in this company, we've got a portfolio of projects. These were assembled by David Lowell. These were, at the time of his passing, basically his targets for his next series of discoveries. Okay, so that's part of the story here as well. But the focus is very much on Warintza, as Dan was alluding to. This is we think anyway, and I think through the presentation, you'll see this is one of the great greenfield copper development opportunities on the board that all the majors are going to be picking from to kind of pick up the exposure to, the future facing kind of metals that are going to be critical to, the global energy transition and decarbonization initiatives that are underway, those transitions. And we released our first resource for this project, the first inventory of the copper on the project last year. It came in at 1.5 billion tons. Okay, and this is primarily within our central deposit. This is now part of a cluster of 6 discoveries that we've made on the property. The 2 most recent discoveries we made earlier this summer, and there are additional targets still to be drilled. There's a lot of potential here within this cluster. But the resource that we released, 1.5 billion tons, that's primarily the central deposit. It takes in kind of the fringes of the adjacent east deposit. And this is global scale by anyone's standards, okay, at 1.5 billion tons. But most importantly, it includes a high-grade starter pit, which is essentially an area of higher grade mineralization you could mine at the front end of the mine plan that really brings forward the cash flows and enhances the economic returns, minimizes the capital payback period, maximizes the IRR and the net asset value within a project like this. Again, this is really key to understand. The major differentiator with this project versus the rest of the projects that are in the kind of the global industry pipeline out there, in addition to that high-grade starter pit and the scale, it's the low capital intensity. So the low absolute capital and then the low capital intensity that this project could be developed at. And that's something that we're going to focus on in this presentation. I think that this is going to be one of the key factors that decides which project get built, which projects sit on the shelf in the coming cycle, where we're going to see a lot of growth in the copper industry. It's going to be all about capital. Okay, and so that's one of the real benefits that you have with this project, where it's situated with the grade, the low strip ratio, and so on. Okay, and then finally, what I'll say is that the project is set in Ecuador, and this is a relatively new jurisdiction for mining, but it's a jurisdiction that desperately needs this kind of mining development. Okay, and we're in the midst of an election cycle now. That's going to wrap up in October, but essentially what you have is a pro-mining candidate up against a pro-mining candidate. Okay, so pro-mining versus pro-mining, both candidates openly acknowledging that they need to accelerate. One of the key priorities for them is going to be accelerating mining development in the country to get themselves out of the kind of the economic crisis that they reside in at the moment. Okay, the company is managed by the Augusta Group. We've got a very simple goal here, as we do with all of our companies. It's surface the value through the exploration and development stage, and then crystallize it in an exit transaction when you've got it ready for a major company to take on and bring into construction and ultimately production. This is what we do at the Augusta Group. We've got a track record of over $4.5 billion of exit transactions in the last dozen years or so, all of them within this niche of exploration and development. Okay, so this includes companies like Ventana Gold. That was a discovery we made. We built it up. We got it through the first economic study and into permitting, sold that for $1.6 billion in 2011. Augusta Resource Corp, $670 million sale in 2014. Newcastle Gold, this is a company that we put together with another gold company in the development stage to make what is now a mid-tier multi-billion-dollar gold company, gold producing company. And then the most recent transaction for us was Arizona Mining. This is, again, a discovery that we made. We built it up. We took it through the early stages of engineering and economic studies. We commenced permitting on the project and sold it on to a major to develop for a little over $2 billion in 2018. Now, the Warintza asset that we have within Solaris, this is the best asset that we've ever had in terms of the scale that we have, a truly global scale asset, and then the value opportunity. And it's situated in what we think is the most strategic metal of all, which is copper. It's the indispensable metal in terms of infrastructure development and the energy transition. All that electricity is running through copper, and copper, therefore, is the most strategic metal that you could be positioned in. And I'm all in. It's not just words. I'm all in terms of my financial investment, putting my family savings into this company. Our executive chairman, Richard Wark, he's invested over $200 million of cash. Okay, so not buying penny shares and then having them revalued and calling that a big investment. $200 million of cash into the company. We're by far the largest shareholders, but it extends down the line through the rest of the organizational structure. Everybody's bought in and passionate and committed to the success of this company. And we are absolutely laser focused on long-term shareholder value. And sometimes there's a distinction between the short term and the long term. The market obviously focuses more on the short term. But for us, I can assure you, we're focused on long term and the end point. Okay, when the asset gets sold, when you've got the asset value, the market timing, the cycle timing, all aligning to deliver the types of transactions that I told you about that make up our history within the Augusta Group. So we're laser focused on that long-term shareholder value. Our key priority, and the thing that you'll continue to hear us hammer on and on about, is limiting dilution. That's how you preserve value per share in these companies. Okay, just looking at the capital structure here. So here we've got a clean structure. Okay, there's no debt on the balance sheet. We don't have any warrants anymore. We dealt with those last year. And we don't have the asset encumbered by any royalties, which you see often in the space, or streams. Really critical with an asset like this, where you're going to eventually be transacting on the asset, that you don't encumber it. We haven't done that. We do, I will say, have an overhang at the moment on because of the balance sheet. We've got a relatively constrained cash position at the moment, about $15 million. If you're wondering our burn rate, it's about $2.5 million per month. So we are financed into next year. But in a bear market tape like we have at the moment, it becomes a focal point when you've got a cash position right there. What we're looking at and what we will pursue are exclusively non-dilutive financing options. We will not be issuing shares at the kind of share price that we're at the moment. Absolutely not going to happen. We've got options on the table. Specifically, I can tell you an offtake option, where for a strategic asset like this, the offtake itself is a very valuable asset. And this would bring in, if we were to sell about 20% of the offtake, this would bring in about $60 million US of financing on its own. Okay, and that would come with a complete buyback. That's a key feature for us that we've negotiated, so that there is no long-term kind of encumbrance on the asset. So those are the types of options, rest assured, that we're looking at to address the balance sheet here. Okay, and I think once we announce that in the coming weeks, then that'll help begin to unwind the kind of the market overhang that you had developed here on this tape. Let me just move on to Ecuador. It's a relatively new jurisdiction for mining, obviously, but it's one of the few globally where you can say that it's got a record since opening its mining sector in 2014, so about 10 years ago, of continuously encouraging growth by cutting taxes, cutting royalties, streamlining permitting. And as I mentioned in my intro, we're in the midst of an election cycle now. But if you look at it, it's basically a head-to-head matchup between two pro-mining candidates, okay, coming from opposite ends of the political spectrum, but perfect alignment in terms of their posture towards the mining sector. Okay, so the first candidate, Luisa Gonzalez, she's a Correísta candidate. So she represents the legacy of Rafael Correa. She was actually appointed by Correa. She was a former minister of Correa's. Rafael Correa was the gentleman who opened the mining sector in the first place back in 2014. He brought in all the reforms that you see, paying dividends in the form of large mining projects now in production in the country, actually just to the south of us, in the district that we're located in. So she represents continuity of that Correa agenda, which is a favorable one, a positive track record for the mining sector. And it's basically a toss-up between whether she is ultimately going to win the election or the challenger, Daniel Noboa. This is a young gentleman business aligned, former member of the National Assembly and Economic Development Commission. Okay, he's a legislator, but Western educated. He was educated in the United States. He's the son of the Bonita banana. If you've seen in the supermarkets, Bonita bananas, those come from Ecuador. His father, Alvaro Noboa, is the wealthiest man in Ecuador. Okay, and Daniel, his son, the presidential candidate, he's absolutely focused on public security is one thing, but then the economic agenda, fostering job creation by, again, going to those positive reforms of lowering taxes, bringing in foreign direct investment, and increasing resource sector production through those initiatives and international free trade agreements. So this is someone that would align most likely with your view or my worldview. Okay, so I think in either option, we can't tell you which way it's going to go. It's basically a 50-50 the way that we see it based on the polling. But either option is going to represent continuity of that pro-mining policy stance that you've had from governments in Ecuador since 2014. Okay, now, of course, anytime you've got an election in Latin America, it represents a bit of an overhang for any casual observers. But we're going to be through this. October 15th is when the election is going to occur, and we're going to have a pro-mining government in place on the other side of that. Now, what we've been doing amidst this election cycle is making sure that we position ourselves so we've got good relationships with obviously both of these parties, and we're positioning ourselves to make sure that we hit the ground running with the new government in place. And so if you look at what we've done, we've recently amended our impact and benefits agreement. So this is the social license with our communities, actually in a ceremony that the Minister of Energies and Mines attended to make sure that we've got a demonstrated clear-cut social license for the project that really is a critical factor to bring on and maintain the government support that we've had to date. Okay, we also made a major breakthrough late last year in December, finally announcing with the government, the outgoing government, of an investment protection agreement for the project, okay, to mitigate against any developments with the election and so on. And this basically freezes in place the mining regulations that will govern the project. It provides for the security of title and investments, and it offers incentives in the form of further tax incentives that bring down the effective tax rate for this project down to about, inclusive of royalties, the lowest level for any jurisdiction in Latin America, and one of the lowest in the world, but certainly the lowest in Latin America. And that's frozen in place. Okay, so we've got that locked in for this project out to 2041 and renewable to 2066 beyond that. Okay, and then the final thing is the project being declared a strategic priority project. Okay, and this gives it an accelerated permitting timeline where we'll complete this project and have it construction ready in 2025. Okay. And you see the government in Ecuador continuing to make progress on the mining sector. Even amidst an election, you've seen positive announcements coming out of the mining sector. The most critical one with relevance to our Solaris project is the Mirador expansion coming through. This is a project that's only about 30 miles to the south of us, almost identical to what you'll see at Warintza in the form of, it's a big open pit copper project, high grades, same setting, obviously, in terms of infrastructure, same metallurgy, same everything else. And you see that with the expansion that's just been approved, that this is going to be one of the largest new copper mines in the world when that's completed. And the government just announced the permit approvals for that. And then most importantly, again, and we're going to touch on this, I promised you, it's coming in at industry low CapEx, industry low capital intensity. That is absolutely critical to take away. So it's a proof of concept, if you will, for our Warintza project in Mirador. We'll look at that in a bit more detail. Okay, and just flip quickly to the next slide. I don't want to spend too much time on this, but just to show you where we're located. This is Southeast Ecuador, and what you see in Southeast Ecuador developing, and it's unique within the country. So this isn't representative of what's going on in the rest of the country, but specifically this area, you've got a mining success story. Okay, you've got the largest mines in the country immediately to the south of us. This is the Mirador mine, which is operated by the Chinese, about 30 miles to the south. And then about 10 miles to the south of that, you've got the FDN mine, which is operated by Lundin Gold. They're a multi-billion-dollar, on the strength of this one asset, they're a multi-billion-dollar gold company. Okay, and this is a unique area in Ecuador. You've got the existing mines, obviously, you've got the infrastructure to support them, you've got the mining economy supporting them with the contractors, the mining labor, all the rest of it. You've got little to no crime going on. Crime is an issue anywhere in Latin America. Ecuador is no exception. But you've got little to no crime in these areas. And most importantly, you've got supportive communities. Okay, so even within the indigenous populations that have been restive in other areas, you've got support for mining development and further mining development in this area. Really, what we're doing is just extending that history of success in this district with our Warintza project. Okay, just turning over and taking a look at the district itself. Essentially, what you're looking at here is a naturally low-cost mining district. Okay, so the largest mine, Mirador, which we talked about, very low-cost open pit mine, milling operation, perfect comparable for what we have. And we're benefiting from the very same advantages that facilitate its low-cost structure. Okay, so you see the highway connection there that connects out to the ports for your logistics. You've got the power grid, which is a national grid in Ecuador. It supplies low-cost renewable power, about 90% hydroelectric power. This is all at low elevation. So we're not high up in the Andes, which account for 40% of global copper production. We don't have to compete with those extreme elevations, poor logistics, and so on. We're very much at low elevation here. We've got low cost labor. This is a huge issue in the mining industry, especially you see this weighing on development decisions in the southern US and Arizona, New Mexico, and so on. And the same thing in British Columbia of Canada, another prolific copper district where labor is a massive issue. Here in Ecuador, we don't have those issues. We've got low cost labor, half the cost of what it is in Chile, the world's + producer. And then finally, something it's easy to overlook, but freely available fresh water. Okay, this is $1 billion plus CapEx item for any project that's built up in the high Andes. In Chile, you need to put in desalination plant at the coast and then pipelines to get that water up to your project. Okay, and when you add up all of these factors, what you're talking about is a difference of billions of dollars of CapEx, okay, which naturally accrues to the benefit of this project. And Mirador provides the proof, okay, where the second phase of that project is now going in, inclusive of the first phase, with all the inefficiencies of doing a phased approach, you're still coming in under $3 billion. Whereas exactly the same scale of production, you were to take that project and put it in the high Andes of Chile, that's an $8 billion CapEx project. Okay, and if your project costs $5 billion more for the same amount of copper production, it's worth $5 billion less. It's that simple. Those are undiscounted cash flows, and then vice versa. We're on the benefiting side of that equation with our project. And all of these figures are going higher in the industry. I mentioned in my intro that my view, and a lot of the major companies that I've engaged in discussions with in the sector share the view that CapEx and CapEx intensity are going to be defining features in the coming cycle. It's going to make the difference between which project goes, which project doesn't go, which project gets acquired, which one sits on the shelf. Okay, and I'll just show you, if we can flip over to the next slide. This is just a history of capital intensity in the sector. And you can see over time with cost inflation and so on, that the capital costs are going up. It's actually outpacing inflation because over time the projects are becoming more complex, they're becoming larger, lower grade, more remote, etc. And so if you look at it, you can see through the 2000 cycle, you needed a copper price in the 250 range to generate a 15% internal rate of return. This is the standard, kind of industry accepted threshold for what makes an economic project. And then you can see as the capital intensity ramps up that the prices that are required to get to a positive decision on a project are increasing alongside it. So we were up to 350 through the 2010s. And then if you look at the recent projects, and now this is really where the inflation is starting to really kick into overdrive. You've got the cost surging higher, the copper price that's required right alongside it. And so recent projects require a copper price over $4.50 a pound, and those figures are only headed higher into the future. And so you can see that the recent projects actually aren't going to make their economic hurdles that were envisioned when those projects were sanctioned if copper prices hang out around where they are at 350. Okay, and this is going to have a real limiting factor in terms of preventing projects from being sanctioned and new production coming on if the copper price stays right around where it is. Okay, if you want a project to be acquired in this kind of copper price environment and developed, you need to be at the low end of the industry cost curve. And that's right where you see the Mirador project, the comparable for our project, right at the bottom end, coming in at $11,000 per ton of copper production. Okay, so even at a $3 copper price, never mind 350, which is the long-term consensus right now, that project is still absolutely a go. And at any of the copper prices that are forecast for the future. Dan Steffens talked about Goldman Sachs forecast. But it doesn't matter whether you're talking about Goldman Sachs or Deutsche Bank or Morgan Stanley or B of A or whoever. Everyone can see that the copper price needs to be much higher into the future to satisfy this explosion of demand that's coming, where we're going to have literally in the span of a dozen years copper demand double in terms of the industry requirement. Okay. So moving on, let's focus a little bit on the project itself. I told you at the outset about the resource that we have. We basically set out with two objectives with this project. So the first was just demonstrate that you've got a world-class project. So make sure that you can, demonstrate in your first resource that you're coming in above that standard to say credibly that you've got a world-class project. Okay, and we did this in that first resource estimate. We came out with 1.5 billion tons. In an open pit with a low strip ratio, primarily within our central deposit, taking in a bit of the east deposit that's adjacent. But then on top of that, demonstrating that you've got a high grade starter pit, okay, to really drive those robust economics. And we've continued drilling since that point. So we've done over 18 months of drilling since that point. We've doubled the amount of drilling that we have in the database now. And this is basically focusing on two things: expanding the overall size of the resource by drilling off the east deposit and the remaining portion of the central deposit. Okay, and then doubling the size of that starter pit. You can see all the growth in the upper right of this slide in the new drilling that's come in to really extend that area of high grade mineralization that you have at surface there. Okay, and so we're just coming to the end of this drilling program. We've got about another 10 holes or so that we need, and then we're going to cut off the database, update our resource estimate. So you'll see that in the first half of next year, where we've grown this resource from 1.5 billion tons into the 2 to 3 billion ton range, just by taking in the central and east deposit. Now, the second key objective was, okay, so the first one, demonstrate that world-class potential. We've done that, and we're going to grow that. Okay, the second one, demonstrate that you can still grow multiple times from that point. And the way that you do that is by surfacing discoveries around those two key deposits that'll come into the resource, central, east. And you see that we've done that. We've made 2 discoveries just this summer in our southeast deposit, the Patrimonio deposit. Remember, we've got existing discoveries that are sitting outside of the resource at our south deposit area, which is an enormous target, larger even than the central deposit at south, but still to be drilled and come into the resources. And then again at the west deposit, a large target there, and targets beyond that, still potential within this cluster. We're demonstrating to convert those targets into discoveries, as we did 2 times already earlier this year. Okay, and that's how you demonstrate you've got A, a world-class project, and then B, an opportunity to double and triple and quadruple that out into the future. Okay, and that's the Warintza cluster. It comes set within a district with enormous potential. You can see even on our claims that you've got a whole series of targets surrounding these porphyries with additional areas of porphyry development that we've got sitting right at surface, related mineralization in the form of skarn showings, epithermal targets. These are gold targets that are sitting there as well. And in addition, this is set against another project, San Carlos Panazzo, that you see out to the west of our project, which hosts a significant resource on its own. And so certainly when you look at the full picture here, you're talking about an entire copper district, which is going to come into development in the coming years. And this is going to be one of the very special, largest and highest grade, best situated projects and districts that comes to the industry for the coming cycle. Something that's very special in terms of an opportunity within this industry. Okay, now our focus again very much on Warintza. The rest of these targets, we understand that we're not going to get value for it, given we're just focused on Warintza. It's enough of a task to surface the value at Warintza alone. And in addition to that, we've got a whole portfolio of assets in the Americas, in Mexico, in Chile, and Peru. What we're going to do when we have a transaction for the development opportunity at Warintza, then we're going to take the rest of this potential, all these other targets, and additional land acquisition coming, and then the rest of the portfolio is going to go into a spin-out company so that our shareholders can continue to benefit from this potential, this amazing potential that's still to be surfaced within this district here. Okay, so let me turn now to talking about the market and then share price performance with Solaris. It's important to touch on the trading history here so that you can understand why we have the opportunity that we have in front of us at this current juncture. And the context you have to understand is that we're within a bear market for copper and copper equities. This began in the second quarter of 2022. It's similar to what you would have experienced in the energy sector in terms of the themes, the rollover in global growth expectations, and so on that were basically driving this. But then in equity land, you have the overlay of a flow of funds. So you have funds flowing out of the commodity sector. So you see this in energy with the bear market in the equities developing over that period. Exactly the same thing happening for the copper sector. Obviously, with the supply side news that you've seen in the energy sector, this has turned around and you've had a bit of a rebound in June. This hasn't happened yet in terms of copper. Okay, so that's the context that you have. Solaris has been a relative underperformer within this group because we've had to deal with the distribution of over $250 million of stock. This came from the parent company that vended in the asset. This was a gold company that ran into a liquidity wall and was a forced seller. This came to the market in a series of tranches. We wrapped that up in March and then cleared out the warrants. These were warrants held by outside investors. We had to clear those through with liquidity in the market. And then we came into snap elections called over the summer in Ecuador. We'll get through that in October. And then the final piece of it is the financing. So we've got to address the balance sheet. Again, I promise you, non-dilutive financing. We're looking specifically at an offtake option. We'll bring in about $60 million, full buyback, so we're not encumbering the asset the way that you would with a stream or a royalty. We'll get the balance sheet addressed, and I think that on its own is going to deliver a significant kind of rebound in lifting the overhang here. And so basically what you're looking at is a tough run, but we've got the plan in place. We're not doing any damage. We're not adding any dilution that'll lower the long-term return. And we're going to work through our program here, advance the asset in terms of the technical studies and permitting, and get ourselves back to a sensible sort of valuation. And you can see the kind of valuation gap between where we're trading currently and then the recent transactions for development stage assets. So this is apples to apples kind of comparisons here in the copper space, where we're down around 0.2 times net asset value. And then you have the average development asset trading hands at about 0.8 times net asset value. Remember, our last sale as the Augusta Group of Arizona Mining, that was a $2 billion sale in 2018. That went out at 1 times net asset value. So those are very much the kind of returns or the kind of exit multiples that you can achieve when you've got alignment between the equity cycle, then the market cycle, and so on. We're not in a position to capture that kind of a multiple where we're currently trading. Okay, nobody is paying those kinds of premiums for assets, even in copper. The key for us here is to put our heads down, work through the plan that we have, advance the asset without incurring dilution. Okay, and I described the plan for you there. You're going to see the non-dilutive offtake financing in the coming weeks. The election is October 15th. We'll have a pro-mining government in place. We're going to update the resource, deliver some significant growth with that resource. And then we're going to be commencing our technical studies to put out the engineering and economic studies for the project and complete the permitting process for this asset beginning next year. Okay, and that is the path that's been successful for us with all of our prior companies that's delivered that $4.5 billion track record that we have of exit transactions. That is exactly the path that we're going to take with this company here. And if we execute on our plans, the market is going to sort itself out, and that's when we'll be at a point where we can enter into a reasonable transaction for our shareholders with this very special asset. Okay, now I'll leave it there. And Dan, if you want to open up to questions, then we can do so right there.
Yeah, I had a couple questions, set in this morning, but I think you're pretty much answered them. But the one was, is Warintza sales ready, or is there a lot more work to be done? And I think what you're saying is you're waiting for this election to get over, get the some more cash in the company with that offtake agreement, and you're going to look a lot more attractive. Now, are you like, you're going forward as if you're going to operate this mine, right? But then you could get somebody come in and buy the whole thing.
Yeah, I mean, you laid out the plan exactly, and not necessarily in that order. The offtake option is very well advanced. That's something that we could announce in the coming weeks, and then the election is October 15th, as you mentioned. But this is an asset, look, it's exactly the same plan. There's no magic. It's the same plan that we had at Arizona and all the companies prior, is that you advance these assets like you're going to be the one building them. Okay, right. Now, obviously, if you look at the industry dynamic, there are a whole pile of majors, not just in the copper space, but the global diversifieds who are over concentrated in iron ore. So this is your BHPs, your Rio Tintos, your Vales, your Fortescues that are all trying to rebalance their portfolios towards these future-facing commodities like copper that are going to be in a mad scramble once the cycle turns for assets like this one. And it's no secret that we've got that strategy as a company to engage with those parties. But look, a transaction is only going to happen at a sensible valuation. Our executive chairman, Richard Wark, he's an old hand at this business. He's put $200 million into this company. It wasn't to generate, a 2 times return. It's a multiple times return is what he's looking for, a high multiple. And so we're going to wait, as I mentioned, until as we continue to advance the asset, we're going to wait until the market cycle aligns with the copper cycle and the M&A cycle, and we're going to capture a reasonable multiple when we do eventually enter into a transaction for this asset.
Okay. I'll just read some of these ones that have been posted. But right now, the larger mining companies, they're in the market looking around, just like setting, but you don't see any big deals coming down the pipe anytime soon to compare to this.
There is absolutely, there is absolutely M&A that you see happening in copper, but really, like, to make a transaction, you need a willing buyer, you need a willing seller. Okay, yeah. And I think with what I'm trying to communicate is, look, we're not trying to sell at the bottom.
Yeah, right.
And yeah, so we've got to get ourselves back to a sensible point in terms of valuation. The way that we do that is by executing on the plan that I described to you. And the market's going to sort ourselves out. In the meantime, the key thing, and again, I keep hammering on this because this is a core principle at the Augusta Group, is preserve long-term shareholder value. And so it's no dilution is really the key, and work through this program.
Yeah. And, I think it's copper's kind of facing the same thing that oil had been until recently, that, we had the Fed making these deals, and, everybody's, the most advertised global recession ever never seems to get here. I really don't think it's going to get here, but, that's holding commodities down. But I think I was on a call the other day, and it said, we've come off of maybe a 10-year period of low commodity prices, a period of abundance, and we're going to be entering a period uh, of low, running out, where supply or demand exceeds supply. You're seeing it in oil already. And just because lack of investment, CapEx investment in developing new plays. And I think that same thing I can see happening in copper. I mean, obviously the demand is out there for sure. I mean, I don't see why. Like Jeremy says, I continue to struggle why copper is in a bear market when there seems to be such a future shortage as anticipated by Goldman Sachs. So what do you think changes that narrative and is probably just get this fear of recession out off the table, right?
I think you're right on the money. I mean, in drawing the parallel to the oil sector, and you basically saw the onset of the bear market in each of those sectors, beginning in Q2 of last year. And then in the oil sector, you came out of it at the end of Q2 this year, I suppose. Going into Q3 is really when it got going. But that was with supply side curtailment, right? And so that's addressing the imbalances in the market on the supply side of the equation. Copper will be a bit different because it's going to be on the demand side. And so what you have happening in copper is basically demand taking off. And I guess it gets slightly less obvious in the United States than it is in, if you look at China or Europe, for example, the other two main economic regions in the world, where you really see this energy transition is much more advanced, where you've got, like in China in particular, even though they're undergoing their version of an economic crisis or recession, deep kind of protracted rolling kind of recession in China, you still see that copper demand is growing really rapidly. I mean, solar installations, wind installations are going gangbusters, up 40% year on year. You see the electric vehicles are about to break 40% market penetration. It's amazing. In the United States, you're down around sort of 8%, but growing rapidly, of course. And then grid investment and charging infrastructure and so on, battery ecosystem and so on, all that investment alongside it. And so even if you've got terrible macro data in China, you've still got pretty good copper data. And of course, that news falls on deaf ears because this is a market. It falls victim to sentiment. But these are whatever happens with the macro, you're going to see that the fundamentals dictate that we have much higher prices in the near future. Okay, so even if demand,
that's what I think with all commodities. I mean, we're ignoring the fact that population growth keeps going on. We're in this mode of electrification of everything, and really, there's no substitute for copper. I mean,
there's no substitute. It's the most fundamental. I mean, even if you have thrifting and so on, you can't. A copper is the best electrical conductor out there. It's the most economic one. You need copper prices up over $10, $11 a pound before you can start economically substituting in aluminum and things like that. So it's quite unlike the rest of the energy transition complex. When you look at some of these other metals like like graphite is kind of in a bear market. Cobalt you've seen in a bear market. Even lithium has kind of come off significantly, which are all kind of subject to technological demand destruction. Whereas with copper, you just don't see that, and there's really no scope for it because it's the indispensable metal, and that's why I say it's the most strategic of all. It's the one metal where it combines the kind of the scale that's relevant to global mining companies. Where you're talking about a $200 billion a year market, not quite the size of the oil sector, but a very significant market. And then where you've got this like rock solid kind of demand growth profile, which everyone needs. The big challenge for the copper industry is just the spot price, and you kind of touched on this disconnect between the questioner touched on this this disconnect between the spot price and then this fundamentally bullish long-term outlook. Okay, and that is something that's actually going to enhance the outlook because I would encourage everyone to go back and look at those capital intensity charts that plot out the relationship between incentive pricing, kind of copper price that you need to assume to sanction one of these copper projects in an industry that's experiencing kind of rampant cost inflation like every other industry.
Yeah. What's the break even copper price you think you need for this project?
Well, look, we haven't published economics yet. We're working eagerly
Okay.
to do so. But if you look at the Mirador mine, which is only about 30 miles to the south of us, it's a perfect comparable for what we have. You can see an actual cost, not feasibility estimates, which are subject to massive, changes in the future and so on. But in the actual costs, you can see that their capital intensity came in with a phased approach, which is inherently inefficient, at $11,000 a ton, which is an industry low. And the incentive pricing required when your capital intensity is that low is less than $3 a pound. So look, even at current copper prices, which don't justify development for 95% of the kind of the industry pipeline out there, this Warintza project still makes sense. And that's really, as I say, that's going to be the key differentiator for the projects that get acquired and the projects that get built in this coming cycle.
Could now your perfect transaction, I guess, if you had your druthers, you would sell Warintza and keep those other projects that are all within that same block.
Yeah, look, we don't want to give away something for nothing. And
Right.
if you've got, for major companies, they're focused on Warintza. So they see Warintza 1.5 billion tons, going to be 2 to 3 billion tons in the coming, kind of quarters, and then you've got multiple times growth potential around that. That's a project for them. Okay, so the rest of the portfolio that we have, and we're going to be adding to that in Ecuador. Stay tuned on that front.
Okay.
But the rest of the portfolio that we have, and then the assets that we have outside of Ecuador and Mexico and Chile and in Peru, they can't assign a value. It's beyond the scope to them, but it has value to us and it'll have value to our shareholders. And so when we've got a transaction for Warintza, we're going to have a spin out that we'll deliver 100% of to our shareholders, where we can continue that, surfacing that value and that legacy of, value creation.
So what you're saying is current people that own the stock when you do that spin out, they're just going to be gifted or get shares in this new spin out company, and then you really sell. Solaris would sell 100%.
Absolutely, that'd be an ideal transaction
And
for
then
us.
but let's say if we're shareholders, we got stock in this new company, Solaris 2 or whatever you want to call it.
Absolutely, there's nothing better from our perspective
Yeah.
as the Augusta Group. I mean, that's the shareholder base that you want to cultivate is a long-term committed shareholder base,
Yeah.
people that you make money for, and then they roll over into the next company and you make more money for them. That's absolutely what we want
So
to
that
do.
would be a capital gain. Let's say you get into 4 and it sells for 16 or something, capital gain on that, but you still got the spin out shares, which I don't know how your basis and tax basis goes into that exactly, but depends on the structure of the transaction, I'm sure. But anyway, I mean, it looks like you got a lot of other projects around there that could go on for years. So.
Yeah, absolutely, and we're prepared for that. So people's situation varies, but we've done the tax planning on our side, so we're prepared for that.
Yeah.
But we need that alignment. We're not going to be selling at the bottom, right? So we need that alignment between the market cycle, the M&A cycle, and so on
Yeah.
to have that.
Yeah. There's somebody posted here. They said he had to log off, but would we send him the PowerPoint? We're recording this, and this is going to go out to all of our members this afternoon. So there'll be hundreds of people watching this replay this afternoon. So that'll be there. And then when it's on replay mode, you can just pause any time to look at the slide. But the other thing is you could go to their website. I think these slides are on your website, correct?
Yeah, we have our presentation on solarisresources.com.
Okay. Yeah. So you can just go there. Let's see. Shouldn't safety and pro-mining status of Ecuador help the value with seemingly more crazies in Peru and Chile as far as investor interest? I think you kind of covered this, but it seems like you said, it's a low crime area, and you've got the full support of the local community because they want the jobs. So yeah, it does seem like a good place. But you can comment on that.
Yeah, look, I don't want to beat up on other jurisdictions. I got friends who have projects in other jurisdictions,
Yeah.
but look, I think Ecuador, specifically this part of Ecuador, southeast Ecuador, an established mining district with a mining economy, mining workforce, population that's benefited massively from mining and supports mining, and specifically this project, where we've got an explicit social license in the form of an agreement with the community to develop the project, yeah, I think that's a pretty special kind of opportunity when you look at the wider context within Latin America. I mean, Peru is sort of famously challenged. Chile, I think the challenges are more on the cost side. Peru also, high cost relative to Ecuador. Argentina, even higher cost. There isn't any current large scale mining in Argentina, but people talk about it. And so, yeah, it absolutely is a special opportunity.
Yeah,
No
why do you
question.
think when I look there, it seems like there's more Canada-based companies working in South America. I don't come across that many American companies working down there.
Yeah, well, look,
Is it just because there's more mining in Canada? Canadians have more mining companies or something?
quite honestly, I think it's Americans have better things to do. America's the engine.
Maybe. Yeah,
America's the engine of capitalism in the entire world and a
yeah,
leader in every field, basically, but most especially technology and some of these areas that have generated tremendous, returns. And the
yeah,
mining sector has been a relative laggard, right? And the energy sector. But
yeah.
the mining sector, and so you don't see a lot of focus in the United States economy on mining. I think in the future it will be more so because I think even legislators who are never forward looking, always responding to crisis, um, are starting to recognize the need to secure supply chains and critical minerals and so on. I think there will be more of a focus in the future, but mining is really more of an international game. It's especially I don't want to say dominated, but you see a special kind of focus on the mining sector by Chinese state-owned enterprises who are very focused on the long-term strategic goals and industrial policy goals of the central government there. Copper is absolutely critical to that. They consume about 50% of the world's copper, and obviously they're ramping up their copper demand as they we talked about the explosive growth that you see in solar, the explosive growth that you see in EVs, building out the grid to match the battery ecosystem, all the rest of it. And so they will absolutely be out there. They've got some issues at the moment that they're grappling with in terms of addressing the kind of the property crisis. They recently emerged from zero COVID and so on. I think in the next year, you'll see them turn their attention and become a lot more active in terms of going out and acquiring these copper assets to secure that kind of next leg of growth to the country.
Yeah, my personal belief is energy is life. I mean, if you want a high standard of living, you have to have access to energy. Affordable, available, reliable energy, and I'm just super bullish on rechargeable batteries and the whole electrification of stuff because a lot of the world doesn't have what we enjoy is we just can we're just so spoiled by having electricity 24/7. You don't have that around the world. And I think in many places where they have intermittent electricity, you're going to, do rechargeable batteries, but you're going to have copper. It's going to be involved in all that electrification process. So that's why I'm just bullish on the whole sector, the whole commodity itself. But I personally don't think I think the EV growth is going to slow a little bit. I'm seeing just because I think the cost of EVs is going to get so expensive because the materials to make them is going to get so expensive. I just, recently bought a new car for my wife and we were looking and they had this is a Kia SUV that she got, and they've got some really cool looking electric vehicles. But I asked the salesman, he said the same size vehicle in electric costs $10,000 or $12,000 more, and people just are looking at them, they're test driving, but they're not buying them. And I said, that's interesting. And maybe it's Texas, we're kind of into big gas guzzling SUVs down here.
Yeah, no, you're not wrong. Like if you look at current large size and of course, like as you mentioned, that the American market prefers larger size vehicles with higher
Yeah,
performance, right, than the global comps. But if you look at the cost of the vehicles, like the materials themselves, there's over $5,000 of lithium. It's just the lithium
yeah,
itself in these electric vehicles. You've got hundreds of dollars of kind of other exotic metals like nickel and so on. that go into these things. But don't discount technology. Technology, if we've learned
Oh, I agree.
anything, makes progress over time. And so you're seeing the advent of new battery technologies that have, for the same or lesser quantity of these basic inputs, are able to deliver longer ranges and better performance. Some of the areas to look at in particular would be solid state batteries.
Hmm.
This will be a big breakthrough that we'll see commercialized, or is being commercialized now. We'll see it rolled out in the coming years and so on. I think that the industry and the relentless drive of technology is going to address a lot of these issues. But yeah, your point is well taken about the current high cost. That's certainly an issue.
Yeah, we live in interesting times, my friend, but we're going to get there eventually. So, all right, here, I think that's about it. If you guys that are on the call have any more questions, please email them to me. I can pass them along. But this one looks very interesting. And I like the fact that you're going to get your finance. So you got some catalysts coming up of the election. You got the financing with the offtake agreement, and this ought to bring a lot. One thing I was going to ask you is how many analysts are covering this? And I looked this morning, and First Call's price target was 1945, about 4 times the current share price. What's kind of the range of the analysts that are covering this? What are they saying? Oh, I got here $19. Okay.
Yeah, absolutely. We've got about a half dozen analysts covering the company. These are the best and brightest. So this is all of the major banks that cover the global mining sector
Mm-hmm.
are represented within that coverage list. And there's a clear consensus by just on the strength of the asset quality and then the outlook for growth and de-risking that we have. So in addition to what you mentioned, we're going to be delivering that big resource update. We're going to continue to make discoveries. We've got multiple times growth beyond that. And then again, critical for, if you think about the industry outlook here over the coming years with the need for projects, starting the engineering and economic studies and permitting to get this project permitted in the coming years. Those are all key catalysts for us to continue adding value and de-risking this asset.
Yeah. Somebody asked, how can they get copies of these reports? Can they send an email to Jacqueline?
Yeah, absolutely. I welcome all, so any questions that you may have or more materials, we're an open book. So reach out to Jacqueline, and we are more than happy to provide materials and jump on the phone if we need to.
Okay. All right. Thanks a lot. One guy just posted a new comment. I follow uranium, which has a similar story as a good investment and a good environment. Huge supply deficit far out, and it finally has gone crazy. Seems like what you had said for catalyst could be sooner rather than later, and I think that's true. I think that's true. I think getting past this election, and so the winner of the election down there comes out and is going to be real pro mining. I think that could be a real catalyst for the stock, don't you?
Absolutely. Like I say, I mean, for casual observers, they need to see the election done. I mean,
Yeah.
if you want to look at the details of it, you can see it's pro mining either way. But
Yeah.
I think you touched on a reality in the space that, you need to get that election done. Absolutely.
Yeah, I mean, everybody's always worried about stuff in South America. I worked for
Sure.
Hess, and we almost invested big time in Venezuela, and then
Oof.
6 months later, they nationalized everything. We would have lost $1 billion or something. Anyway,
Yeah.
all right, man. Thanks a lot. I appreciate
Yeah.
it. Once you get back down here to do a luncheon again, we're starting to pick up our luncheon. The last one we did, we had 45 people attend. We moved back to our old location, which is helping the attendance. So that's it for now. Thanks, everybody. And Sabrina, why don't you end it right here? And then we will be sending out the replay link later today.